All right, welcome to the deep dive. Today we are going deep into the world of accounting.
Ooh, accounting.
Yeah, I know, right? But don't worry.
Sounds a little dry.
Yeah, a little bit. But we're going to try to make it as interesting as possible
Okay.
and hopefully clear up some of the mysteries behind it. We're going to be using Mike Piper's book, Accounting Made Simple.
Oh, I like that title.
Yeah, accounting explained in 100 pages or less. So hopefully we can do it in even less time than that.
That's a good goal.
All right. So often you hear that accounting is like the language of business, right? What do you think about that?
It's a good analogy, right? Because it's how businesses track their finances, their performance, and their overall health.
Yeah, it's all about recording and communicating financial information, right? So you've got your income, your expenses, you've got your assets, what you own, and your liabilities, what you owe.
Yeah, like a snapshot of where a business stands financially.
Exactly. And the cool thing is, once you understand this language, you can really start to decipher the story behind any business.
It unlocks a whole new level of understanding.
Yeah. So in this deep dive, we're going to break down the key concepts from Piper's book, focusing on the core financial statements, the balance sheet, income statement, and cash flow statement.
Big three.
Exactly, the big three. And we're also going to touch on some of the fundamental accounting principles like JAP, debits and credits, and the difference between cash and accrual accounting. So, ready to dive in?
Absolutely. Let's do it.
All right, let's start with what Piper calls the bedrock of accounting, the accounting equation.
Okay, the foundation.
Yeah, the foundation.
All right.
So what is this magical equation?
Well, it's actually pretty simple. It states that assets are equal to liabilities plus owner's equity.
Okay, break that down for me.
Sure. Assets are everything a company owns that has value.
Okay, like what?
Think cash, inventory, buildings, equipment, even things like patents or trademarks.
Okay, and liabilities.
Those are the company's debts, its obligations to others.
Right, so like loans or money you owe to suppliers.
Exactly.
Okay, now what about owner's equity? What's that all about?
Owner's equity represents the owner's stake in the business. It's what's left over after you subtract liabilities from assets.
So it's like what the owners would get if they sold everything and paid off all the debts.
Precisely. Piper describes it as a plug figure because you can calculate it by plugging in the values for assets and liabilities.
Oh, I like that. It makes it easy to remember.
It's a helpful way to think about it.
Okay, so let's take a real-world example. Let's say you buy a house for, let's say $400,000, and you put down a $100,000 down payment.
Okay, got it.
So you have a $300,000 mortgage.
Right.
So the house is the asset, right?
Yeah.
$400,000. The mortgage is the liability, $300,000. And your equity, your stake in the house is...
It would be $100,000.
Exactly. So it's like 400,000 equals 300,000 plus 100,000.
The equation always balances.
Right. It's all beautifully balanced. And another interesting point that Piper makes is that my asset is your liability. What do you make of that?
It highlights the interconnected nature of finance. For example, if a company takes out a loan, that's a liability for them, but it's an asset for the bank lending the money.
Right. It's their claim on the company's future repayments.
Exactly. Or think about a simple bank deposit. It's an asset for you, but it's a liability for the bank because they owe that money back to you.
Oh, I see. So two sides of the same coin.
Exactly.
Okay, so now that we have this fundamental accounting equation, how do businesses actually organize and present all this financial information?
That's where the financial statements come in. They provide a structured way to communicate the financial position and performance of a business.
Right, so we're talking about the balance sheet, the income statement, and the cash flow statement.
Precisely. And we'll also touch on the statement of retained earnings, which is a key link between the income statement and the balance sheet.
Okay, so let's break these down one by one. Starting with the balance sheet, what story does it tell?
The balance sheet is like a snapshot of a company's financial position at a specific point in time.
So it's like a photograph.
Exactly. It captures what a company owns, what it owes, and what's left for the owners on a particular date.
Okay, so if the balance sheet is a photograph, what's the income statement?
The income statement is more like a video showing the company's financial performance over a period of time.
So it tells us how much money the company made or lost during a specific period.
Precisely. It tracks revenues and expenses over a month, a quarter, or a year.
Okay, got it. And then you've got the cash flow statement. What's that all about?
The cash flow statement tracks the actual movement of cash both into and out of the company over a period of time.
So it's less about accounting principles and more about when the actual dollars change hands.
Exactly. It focuses on the cash inflows and outflows from operating activities, investing activities, and financing activities.
We'll dive deeper into those categories in a bit. But first, let's go back to the balance sheet and really unpack its structure.
Okay, good idea. As we've discussed, the balance sheet is a formal representation of the accounting equation. So you have assets on one side and liabilities and owner's equity on the other.
And it's always in balance, right?
Yeah.
Assets must equal liabilities plus equity.
Always. It's the fundamental principle of accounting.
Okay, so let's talk assets. What are some of the typical categories we see on a balance sheet?
Well, you usually start with the most liquid assets, those that can be easily converted to cash. So first up is cash and cash equivalents.
Okay, cash is pretty straightforward, but what are these equivalents?
Cash equivalents are short-term, highly liquid investments that can be readily converted to cash, typically within 90 days. Think of things like treasury bills or money market funds.
Okay, so basically cash or near cash.
Exactly. Then you've got accounts receivable, which is the money owed to the company by its customers for goods or services already delivered or rendered.
So it's like an IOU from your customers.
Precisely.
Got it. And then what about an inventory?
Inventory represents the goods a company holds for sale in the normal course of business. For a retailer, it's the merchandise on their shelves. For a manufacturer, it's the raw materials, work in progress, and finished goods.
Okay, that makes sense. And then you have property, plant, and equipment, right?
Yes, PP&E, as it's often abbreviated, these are the company's long-term tangible assets used in its operations.
So like buildings, machinery, vehicles.
Exactly. They're not intended for resale, but rather for use in generating revenue over time.
Okay, so that covers the asset side. Now, what about liabilities? What are some of the key categories there?
On the liability side, you often see accounts payable, which is the money a company owes to its suppliers for goods or services received but not yet paid for.
So it's basically the flip side of accounts receivable.
Exactly. It's the company's short-term obligation to its vendors. Then you have notes payable, which usually represents formal loan agreements.
So like bank loans or other types of debt financing.
Precisely. These obligations usually have specific repayment terms and interest rates.
Got it. So that covers the main categories of assets and liabilities. Now, what about owner's equity? What are the key components there?
Within owner's equity, you'll generally see common stock, which represents the initial investment made by the owners when the company was formed.
So it's like the seed money that got the business going.
Exactly. And then you have retained earnings, which is the cumulative net income the business has earned over its lifetime, minus any dividends paid out to shareholders.
Okay, so retained earnings is essentially the profit that the company has kept and reinvested back into the business.
Precisely. It's a measure of the company's accumulated profitability that hasn't been distributed to the owners.
Got it. Now, Piper also makes a point about distinguishing between current and long-term assets and liabilities, right?
Yes, that's important for understanding the company's short-term liquidity, its ability to meet its obligations that are coming due soon.
Okay, so what's the difference between current and long-term?
Current assets are expected to be converted into cash or used up within 1 year.
So things like cash, accounts receivable, and inventory.
Exactly. Current liabilities are obligations that are due within 1 year.
Like accounts payable or short-term loans.
Precisely.
Okay, so anything beyond a year is considered long-term.
Right. Long-term assets include things like property, plant, and equipment, while long-term liabilities might include mortgages or bonds that mature in several years.
Got it. Now, Piper also talks about the value of looking at multiple period balance sheets.
Right. Absolutely. When you compare balance sheets from different periods, you can start to see trends in the company's financial position.
Right. So instead of just a single snapshot, you get a sense of the company's financial journey over time.
Exactly. You can see whether assets are growing, whether debt is increasing or decreasing, and whether the owner's equity is expanding.
Piper provides a good example showing how analyzing multiple periods can reveal both positive and potentially concerning trends.
Yeah. They use a company with increasing assets and decreasing liabilities, which looks good on the surface. But then they point out that accounts receivable has also increased significantly.
Right. And that could signal a potential problem. Maybe the company's having trouble collecting payments from its customers.
Exactly. It highlights the importance of looking beyond the overall numbers and delving into the individual accounts to understand the underlying story.
So analyzing multiple balance sheets gives us a much richer understanding of the company's financial health and direction.
It's like connecting the dots to see the bigger picture.
Okay, let's move on to the income statement. What's its main purpose?
The income statement tells us how profitable a company has been over a specific period. It follows a pretty standard format, starting with revenues and subtracting expenses to arrive at net income.
Okay, so revenue is the money coming in, expenses are the money going out, and the difference is the profit, or the loss if expenses exceed revenue.
Exactly.
Now, Piper talks about this concept of gross profit. What's that all about?
Gross profit is the profit a company makes after deducting the direct costs associated with producing the goods or services sold.
So it's revenue minus the cost of goods sold, or COGS.
Right. COGS includes the costs of raw materials, direct labor, and manufacturing overhead.
Okay, so for a t-shirt company, COGS would be the cost of a blank t-shirts, the printing costs, and maybe the labor directly involved in making the shirts.
Exactly. And Piper's example shows how if a t-shirt company sells shirts for $1,000 and their COGS is $400, their gross profit is $600.
Okay, I see. So gross profit is like the first level of profitability before considering all the other expenses involved in running the business.
Precisely.
Now, what about operating expenses?
Operating expenses are the costs incurred in the normal day-to-day running of the business, but they're not directly tied to the production of goods or services.
So things like rent, salaries, utilities, marketing, that sort of thing.
Exactly. Those are all operating expenses. When you deduct operating expenses from gross profit, you arrive at operating income.
Okay, so operating income is like the profit from the company's core operations before taking into account any non-operating items.
Precise.
Now, what are these non-operating items?
Non-operating items are revenues and expenses that are not part of the company's regular business activities.
Okay, give me some examples.
Things like interest income or interest expense, gains or losses from the sale of assets, or maybe a one-time lawsuit settlement.
Okay, so there are things that might happen, but they're not part of the normal ebb and flow of the business.
Right. After accounting for any non-operating items, you arrive at net income, which is often referred to as the bottom line.
So net income is the final profit or loss for the period, after all revenues and expenses have been considered.
Exactly.
Now, Piper mentions a debate about whether operating income or net income is a better measure of a company's true performance.
Right. The idea was that focusing on operating income might provide a clearer picture of the company's core profitability, excluding those less frequent non-operating items that can sometimes distort the picture.
But then some companies started playing games trying to classify recurring operating expenses as non-operating to make their operating income look better.
Yeah, they called it creative accounting.
So it's important to be aware of these potential manipulations and look at both operating income and net income to get a comprehensive view.
Definitely. Be critical and dig deeper when analyzing these figures.
All right, let's move on to the statement of retained earnings. What's its main function?
The statement of retained earnings shows how a company's retained earnings balance has changed over a period of time.
Okay, remind me again, what exactly are retained earnings?
Retained earnings represent the cumulative net income a company has earned over its entire history, minus any dividends paid out to shareholders.
So it's the profit that the company has kept and plowed back into the business.
Precisely.
The example with ABC Construction in 2011 and 2012 really clarifies this, doesn't it?
Yeah, it shows how net income flows into retained earnings and how dividends paid out reduce retained earnings.
Right, so if ABC starts with no retained earnings, earns $60,000 in net income in 2011, and pays out $20,000 in dividends, their retained earnings at the end of 2011 will be $40,000.
Exactly. And then that $40,000 becomes the beginning balance for 2012. They earn another $80,000 in 2012, pay out another $20,000 in dividends, and the retained earnings at the end of 2012 is $100,000.
Like a running tally of the company's accumulated profit that's been reinvested.
Precisely.
Now, you mentioned that the statement of retained earnings is a bridge between the income statement and the balance sheet. How does that work?
The net income from the income statement flows directly into the statement of retained earnings. Then, the ending retained earnings balance from that statement gets reported on the balance sheet as part of the owner's equity section.
So it really ties these statements together, doesn't it?
It's a key link in the chain.
Piper provides a step-by-step illustration of this connection, which is really helpful.
It clarifies how the different statements relate to each other.
Now, one important point Piper makes is that dividends are not an expense. Why is that?
Dividends are not considered an expense because they're not a cost incurred to generate revenue. They're a distribution of profits to the owners of the company.
So they come out of retained earnings, not from revenue.
Exactly. It's a way of sharing the company's profits with its shareholders.
Got it. And another key point is that retained earnings are not the same as cash.
Absolutely. A company might have a large retained earnings balance, but that doesn't mean they have a pile of cash sitting in the bank.
Right. Those retained earnings might have been reinvested in new equipment, inventory, or used to pay down debt.
Exactly. Retained earnings represent the accumulated profit that's been plowed back into the business, not the cash on hand.
Okay, now let's tackle the cash flow statement. What's its primary purpose?
The cash flow statement reports the actual cash inflows and outflows of a business over a period of time.
So it's all about the movement of cash when it comes in and when it goes out.
Exactly. It provides a different perspective than the income statement, which is based on accrual accounting.
Right. Accrual accounting focuses on when revenue is earned and when expenses are incurred, regardless of when the cash actually changes hands.
Precisely. But the cash flow statement is all about the actual cash flow.
Piper gives a good example with XYZ Consulting. Let's say they perform services in December, but they don't receive payment until January.
Right. Under accrual accounting, that revenue would be recorded in December on the income statement, but the cash flow wouldn't show up until January on the cash flow statement.
So the cash flow statement gives a clearer picture of the company's actual cash position.
Absolutely. It's essential for understanding a company's liquidity and its ability to manage its cash flow effectively.
Now, Piper highlights two key differences between the cash flow statement and the income statement.
Yes, one difference is this timing of recording transactions that we just discussed, cash versus accrual.
Right. And the other key difference is that the cash flow statement includes transactions that never appear on the income statement.
Exactly. Things like taking out or repaying loans, issuing or repurchasing stock, or paying dividends.
So if XYZ Consulting gets a bank loan, that's a cash inflow that would be reflected on the cash flow statement, but it wouldn't be revenue on the income statement.
Precisely. It's a financing activity, not an operating activity that generates revenue.
Okay, that makes sense. Now, how is the cash flow statement typically structured?
It's usually divided into three main sections: operating activities, investing activities, and financing activities.
Okay, let's break down each of those. What are operating activities?
Operating activities are the cash flows related to the company's core business operations.
So, cash from sales, cash paid to suppliers and employees, cash paid for rent and utilities.
Exactly. It's the day-to-day cash flow generated by the business.
Okay. Now, what about investing activities?
Investing activities involve the purchase and sale of long-term assets.
So, if the company buys a new piece of equipment, that's a cash outflow under investing activities.
Right. And if they sell an old piece of equipment, that's a cash inflow. It also includes investments in things like stocks and bonds.
Okay, got it. And finally, what are financing activities?
Financing activities involve cash flows related to how a company raises and repays capital.
So this would include things like issuing stock, taking out loans, repaying debt, and paying dividends.
Exactly. It's about the company's interactions with its owners and creditors.
Piper's example cash flow statement nicely illustrates how these different activities are categorized and presented.
It helps to see it laid out visually.
Okay, we've covered a lot of ground with these financial statements, but how do we actually make sense of all these numbers and draw meaningful conclusions about a company's performance?
That's where financial ratios come in. They help us analyze the information in the financial statements and gain deeper insights.
Because ratios are like tools for digging deeper and extracting more meaning from the numbers.
Exactly. They help us assess things like liquidity, profitability, leverage, and efficiency.
Piper introduces several key categories of ratios. Let's start with liquidity ratios. What are those all about?
Liquidity ratios measure a company's ability to meet its short-term obligations.
So can they pay their bills as they come due?
Exactly. The two main liquidity ratios are the current ratio and the quick ratio.
Okay, how are those calculated?
The current ratio is calculated by dividing current assets by current liabilities. It shows whether a company has enough current assets to cover its current liabilities.
Okay, so a current ratio of 2 would mean that the company has twice as many current assets as current liabilities.
Precisely. The quick ratio is similar, but it excludes inventory from current assets.
Why exclude inventory?
Inventory isn't always easy to convert to cash quickly, so the quick ratio gives a more conservative view of a company's immediate liquidity.
Okay, so it's like a worst-case scenario test.
Exactly. Piper's ABC Toys example shows a company with a current ratio of 1, meaning their current assets equal their current liabilities. But their quick ratio is only 0.5.
So if they had to pay all their bills right away without selling any inventory, they might have a problem.
Exactly. It highlights how the quick ratio can be a more telling measure in some situations.
Okay, now what about profitability ratios?
Right.
What do they tell us?
Profitability ratios measure how profitable a company is relative to its size or the resources it uses.
Okay, so it's not just about making a profit. It's about making a profit relative to how much you've invested.
Precisely. Some key profitability ratios include return on assets, return on equity, and gross profit margin.
Okay, break those down for me.
Return on assets, or ROA, is calculated by dividing net income by total assets. It measures how efficiently a company is using its assets to generate profit.
So a higher ROA is better because it means the company is generating more profit with its assets.
Exactly. Return on equity, or ROA, is net income divided by owner's equity. It shows how effectively the company is using its investors' money to generate returns.
So a higher ROE means that the company is providing a better return to its investors.
Precisely. These ratios are particularly useful for comparing the profitability of companies of different sizes.
Okay, and what about gross profit margin?
Gross profit margin is calculated by dividing gross profit by revenue. It tells us what percentage of each sales dollar remains as profit after covering the cost of goods sold.
So a higher gross profit margin means the company is keeping more of its revenue after paying for the direct costs of its products or services.
Exactly. Piper's example of Virginia's cosmetics business with a 75% gross profit margin illustrates a very profitable business.
Yeah, that's a pretty healthy margin. But he emphasizes the importance of comparing these margins within the same industry.
Absolutely. A 75% margin might be great for cosmetics, but it might be terrible for a grocery store where margins are typically much lower.
Okay, makes sense. Now, what about financial leverage ratios? What are those all about?
Financial leverage ratios measure the extent to which a company is using debt to finance its assets.
Okay, so it's about understanding how much debt the company is using compared to its equity.
Precisely. Two key leverage ratios are the debt ratio and the debt-to-equity ratio.
Okay, how are those calculated?
The debt ratio is calculated by dividing total liabilities by total assets. It shows what proportion of the company's assets are financed by debt.
So a debt ratio of 0.5 would mean that 50% of the company's assets are financed with debt and the other 50% with equity.
Exactly. The debt-to-equity ratio is calculated by dividing total liabilities by owner's equity. It shows the relationship between debt and equity financing.
Okay, so if a company has a debt-to-equity ratio of 1, that means they have an equal amount of debt and equity.
Precisely. Piper uses the example of XYZ Software to illustrate the trade-offs of leverage.
Right. Using more debt can magnify returns for the owners if things go well. But it also increases the company's financial risk because they have to make those interest payments.
It's a balancing act. A company with too much debt can find itself in trouble if its profitability declines or interest rates rise.
Okay, now let's talk about asset turnover ratios. What do they measure?
Asset turnover ratios measure how efficiently a company is using its assets to generate sales.
So it's about getting the most bang for your buck, so to speak, from your assets.
Exactly. Two key turnover ratios are inventory turnover and receivables turnover.
Okay, what's inventory turnover all about?
Inventory turnover is calculated by dividing the cost of goods sold by the average inventory. It shows how many times a company's inventory is sold and replenished during a period.
So a higher inventory turnover is generally a good thing.
Yes, it usually indicates strong sales and efficient inventory management. If a company can sell its inventory quickly, it doesn't have as much cash tied up in inventory, and it reduces the risk of obsolescence.
Okay, that makes sense. And what about receivables turnover?
Receivables turnover is calculated by dividing credit sales by the average accounts receivable. It measures how quickly a company is collecting on its credit sales.
So a higher receivables turnover means that the company is collecting its money faster.
Exactly. And a shorter collection period is generally preferred because it improves cash flow.
Piper points out that if a company's average collection period is steadily increasing, that could be a red flag.
Right. It could suggest that the company is having trouble collecting its receivables, which could lead to cash flow problems down the road.
Okay, we've covered a lot of ground in this deep dive into accounting fundamentals.
We've really only scratched the surface, but hopefully we've provided a good foundation for understanding the key concepts.
I think so. Even just grasping the basics of the accounting equation, the main financial statements, and these key ratios can make a big difference in how you view businesses.
Absolutely. It gives you a new lens through which to assess their financial health and performance.
Now here's a thought-provoking question for our listeners. As you go about your day and interact with different businesses, how might these concepts inform your perceptions?
Yeah, think about the companies you buy from, the banks you use, the service providers you rely on.
What might their financial statements reveal? What could you learn from looking at their liquidity, their profitability, their leverage, and their efficiency?
Could you spot any potential red flags or signs of strength?
It's fascinating to think about how these seemingly dry accounting concepts can actually provide such valuable insights into the real world.
It's all about understanding the language of business.
And this deep dive has really just been the beginning. As Piper goes on to explore in his book, there's so much more to learn about accounting.
There's the whole world of generally accepted accounting principles, or GAAP, the double entry bookkeeping system, the intricacies of cash versus accrual accounting, depreciation methods, inventory costing methods, and so much more.
Maybe we can delve into some of those topics in future deep dives.
I'd be happy to explore those further.
But for now, we've given our listeners plenty to chew on.
I hope so.
Thanks for joining us on the deep dive. Until next time.
See you then.